Section 1, Topic 7. So first, California's graduated income tax. The type and quantity of taxes citizens pay depends on which state they live in, depends on the sources of income, so whether they're getting it from their business or from their normal job or from side gigs. Then it also depends on how much money they're coming in, because as you can see on the chart, it varies. Generally, the richer you are, the more tax you'll get. And then finally, it also depends on your spending. So if you put a lot of money towards charity or other tax cuts, generally that cuts from the bill that you're going to pay towards your taxes. So this chart right here shows the income brackets for tax owed here in California. So for example, if you make between 10 to 25K, you're going to get taxed 2% on California level, and then you'll get taxed differently in the federal level. There's 3 other main sources of income that get taxed aside from an ordinary job. The first one being self-employment and gigs, which has a tax rate of 15.3%. This splits down into 12.4 for Social Security tax and 2.9 for Medicare tax. Social Security tax is essentially tax that helps out the elderly and the disabled folks. This was enacted during the Great Depression just to help out people who need it, because a lot of people can't afford to work or are not able to work, so they need to be covered. And then the 2.9% is Medicare, which is essentially medical coverage for impoverished people, or if you're under certain brackets of income, you will also get like public medical coverage. And then the second source of income that needs to be taxed differently is business or corporate tax, which is just a flat rate across America of 21%. It will have additions depending on regions, but it varies a lot. The general concept is that it's 21%. And then finally, investments in stocks and assets are both taxed federally according to the capital gains tax brackets, because there is no California tax for them. And the capital gains, that is short-term and long-term, they'll be covered more in depth later. Next up is sales tax. So a sales tax is essentially taxes paid on different types of goods that are sold within states or on online sales. So in California, the base tax rate is 6%, with an additional 1.25 to 4.75%. For example, if you buy a piece of bread from the grocery store, you will pay a minimum of 7.25%, which varies by your location. So in more expensive areas, such as like San Francisco, you should expect to pay upwards of like 10.75%. And in more rural area, such as like the farmlands of California, generally you would pay less tax. But this also varies by the product, so products that are imported would have more tax, because California uses a modified origin-based sourcing system for sales tax, which means that the seller's location affects the state, county, and city tax, while the buyer's location affects the district tax. So for example, if you're shipping an item, the person buying it will affect the district tax that's being paid on it, and the person selling it will affect the state, county, and city taxes. So overall, when the buyer buys it, they'll pay all the combined taxes, and then the seller will pay those taxes to the government. And then some certain groceries and goods are exempt from taxes. And finally, online purchases that deliver to California address are subject to California sales tax, which means that even if you're shipping from abroad, you'll still have to pay tax based off the buyer's location. Next up, gross, net, and taxable income. So gross income is the total income from all sources before any deductions or taxes. Essentially, it's the overall. And then taxable income is the gross income minus deductions or exemptions. Essentially, deductions and exemptions will be explained more in depth later, but they're stuff that subtract from your gross income so you can pay less taxes, which is good for the taxpayer because it allows them to have more money for either themselves or for the people around them, or for their company, and so on. And then net income is the taxable income minus all taxes and deductions. So it's the final money that you take home with you. Next up, W-2 versus 1099 income reporting. So both forms are used for reporting income and amount of taxes paid to the government. A W-2 form is used for reporting wages and salaries from employers. Taxes are typically withheld throughout the year. So your average 9-to-5 worker is going to be filling out W-2 forms when tax season comes around. And they will have money withheld from their paycheck throughout the year that estimates how much they owe in taxes. And then after filing these forms, they can get some money back if too much money was withheld. And then 1099 forms are for reporting different types of income, such as self-employment earnings, gigs, interest, dividends, rental income, any sales of property that you make, stuff like that. And then these ones are generally not withheld, which require the taxpayer to make estimated tax payments. This is generally more risky because if you don't make the right payments, you can get in trouble with the IRS. But it also allows for a lot more flexibility because you can invest your money, and then later when the tax season comes around, you can worry about giving the money to the government. Section 1, Topic 8, Capital Gains Tax Rates. So first of all, let's define some key terms. We have earned and unearned income. So earned income comes from providing work or a service, such as having a job, owning a business, self-employment, or even gigs. So this can be thought as having an active income, something that you're actively working on. If you're constantly going into work every day and doing something, or if you actively mow someone's lawn, then that is most likely an earned income. And then unearned income comes from interest rates, dividends, rental properties, capital gains, distributions, and so on. These are essentially things that work for you. Your money works for you. You're not really doing much from a rental property. You just collect the rent. Maybe every now and then you'll fix something on the property. But generally, it's passive income that just comes passively. And then dividends and interest rates are the same concept, where generally the money flows in once you have it set up. The same as capital gains distributions, they generally just come your way. Essentially, it's just money that kind of flows in. Next up is federal income tax. This is the very basic tax that the average person thinks of when they think of tax. It is just tax collected by the federal government for health programs, social security, defense, and security, and all the basic functions of the government. Essentially, it is the citizens of the country paying money to help the country put its best foot forward. So when citizens pay their taxes, the country overall gets better health programs, gets better civil works programs. It helps build the military. It helps build security, like keeping the country safe. It protects us in wars and so on. Now, essentially, it just goes through brackets depending on the people's incomes. So people that make less money naturally get taxed less. Next up, federal capital gains tax. This is tax imposed by the federal government and is on profit from selling assets. So it's split into long-term and short-term. Long-term is anything that's held longer than a year before it's sold. And short-term are assets that were owned for a year or less. Long-term assets are usually something such as houses that you've had for many years, or maybe even cars that you've had for a long time that also gets taxed. Short-term is generally things that you're just holding for like a smaller amount of time. And this could also be a car, just a car that you're flipping perhaps. So the brackets for this is different. It varies for both of them. In California, they're both taxed underneath your income. It is grouped together. You only get 0% on long term if you're an individual with less than 47K, or if you're filing joint with somebody, as if you're married, with less than 94K, or if you're a household head with less than 63K. These vary because generally people who are like the head of a household need to have more money to carry their family. And then people that make more money will get paid upwards of 20 or more percent. And for short term, this ranges from 10 to 37%. Section 1, Topic 9, Tax Credits and Deductions. So first of all, let's explain the W-4 form. This is a form that allows your employer to determine how much will be withheld from your paycheck for federal income taxes and sent to the IRS. This is different from the W-2 form because the W-2 form is more for you, while this form is what tells your employer how much to withhold. This will need to be filled out before worrying about any credits or deductions. So first of all, a credit is essentially an amount of money that reduces the bill, and there's three types. There's a non-refundable credit, refundable, and partially refundable. So a non-refundable is an amount that you can get reduced from the tax bill, and if it is more than the actual tax bill, then you will not get any money back. For example, if you have to pay $1,000 in taxes and you have $2,000 non-refundable tax credit, that means that the extra $1,000 that go over the tax bill will not come back to you. It is just essentially lost money. The refundable is the opposite, where if you have $1,000 tax bill and you have a $2,000 tax credit, then it'll essentially erase the first $1,000 of the bill and then give you an extra $1,000. And then partially refundable, this one varies a lot more, and usually it is a percentage that is refunded. And then here are some more examples. So if you have a $900 tax credit and you have to pay $3,000 in taxes, you now only have to pay $2,100 because that $900 tax credit essentially removed part of the check that you have to pay. And then some common credits is an adoption credit, which is just essentially getting money for adopting children. The next one is a clean vehicle credit, which credits are given for purchasing a clean vehicle like a Tesla or a hybrid vehicle in some cases. And then there's elderly and disabled credit, which is credits given to the elderly and disabled who naturally should not be obliged to pay taxes because it's very costly and we need to help people out. And then tax deduction are what reduces the taxable income. So these are the IRA, 401k, any medical insurance provided by your employer, another retirement plan. Sometimes tax deductions can also be donations. This goes into what we discussed earlier about how your spending can decrease your taxable income. Because if you're spending part of your gross income into your IRA and 401k, donating it, and medical insurance money, essentially your net income will be decreased, and so will your taxable income. And most of them compound over time. These plans that will compound over time. So this graph shows how at the beginning it won't grow much from simply saving in a savings account, but by putting it in an IRA or a 401k, over time it can exponentially grow. Section 1, Topic 10, Retirement Income. So there's a few different potential sources of retirement income, which is just the income that you're still getting after you retire. And they usually are some sort of combination of continued employment earnings, so any money that you're getting from the company or business that you own or work for after you retire, or it can also be Social Security, which is just money from the government essentially. It can also be employer-sponsored retirement plans like your 401k or your IRA, because sometimes you get money from your employer that's being matched as you build up towards those plans. It can also come from personal investments, and these kind of branch into this list of sources, which is the Social Security benefits, is the plans that are 401k, IRAs. I already mentioned most of these. It can also be pensions. It can be personal investments that are stuff like stocks, bonds, mutual funds, annuities, any real estate investments or rental income if you own any properties. It can be part-time work and continued employment, because some people retire but continue to work like a smaller job or do some sort of smaller labor just so they can feel still useful for those around them, and they can still help out community. It can also be savings accounts and certification of deposits. Next up, diversifying your income and the importance of it. So once you retire, you want to make sure these income sources that we just mentioned are pretty diversified, because it'll help you with three things: your stability, your risk management, and to counteract inflation. So essentially you need to have a combination of like your retirement plans and personal investments, because these are going to be the strongest two sources of income. And this will lead you to stability in the sense that any fluctuations from one source will be kind of balanced by the other sources. So if your personal investments, as like your properties, are not doing as well, your retirement plans can help cover. And then risk management, it essentially protects against market crashes, because generally if one section of the market crashes, another section can either stay the same or go up. And finally, it counteracts inflation, because if you have your sources diversified, every part of the market will go up with time eventually, and you will grow with inflation rather than being left behind. Next up, employer-sponsored retirement plans. So I'm going to explain more in detail of how these work. So usually stuff like the 401k, you can qualify for an employer match, where essentially you and your employer are both putting the same amount into the savings account that grows with the stock market over time. So the 401k and IRA both are money that you put in now and is deducted from your gross income, which brings down your taxable income. And then later on, when you take money out of your 401k after you've retired, that money gets taxed rather than being taxed early. And then the Roth IRA is money that you put in from your net income, and later on when you take it out, it does not get taxed. Next up, Social Security. So this is given by the federal government. It is standardized across the United States and based off the highest 35 years of earning from your career. So if you've had multiple jobs, you're just going to take the 35 years that you've made the most money. Its average is about 1.8K per month. Of course, it varies based off like if you have disabilities or if you're a family member, if you're like married or not, and so on. It has a lot of variety. And this was established in 1935 as part of FDR's New Deal to fight the Great Depression. Section 1, Topic 11, Gig employment and small businesses. So gig employment is generally defined as small services or jobs that you pick up. It's just gigs. And it can be things such as driving a cab, doing delivery service, landscaping, even cleaning pools, walking dogs. Those all count as gig employment because you're just doing separate gigs and you're not really tied down. So it can be great because of the freedom and the flexibility that you get. Since you're not really working for someone, you have a lot more options of when to work and how to work, and you can set your own prices. It also has minimal training because generally you can pick up jobs depending on what you already know how to do. It also has a variety of different jobs that you can do depending on the variety of different things that you know how to do. It can act as supplemental income since it is not highly profitable. You can't really have a lot of money flowing in from this. Next up, small business. Owning a small business can grow to be a person's primary career or can supplement income from other sources. So this has a lot more potential than gig employment because small businesses, their growth is essentially exponential. You can grow as much as you possibly can. It has a couple pros and cons. So the pros, the flexibility, it has the same flexibility as gig employment essentially, but as you grow, you get more and more tied down though. Its earning potential is inversely related to that. So as you grow, you get way more earnings. And then independence, you get to be independent from any employer or any other like outside factors that can influence you. And the cons is the risk because you take on a lot of personal risk in some cases. Ideally, you wouldn't use your own money, so it won't be personal risk in the form of money, but it'll be a lot of your time and efforts going towards this, and you don't know how it will turn out. It can also be long hours, especially when you're starting up. You can work a lot and take on essentially what would be your future coworkers' work because you haven't hired the future employees yet. So when you're first starting up, you do a lot of work. It's also going to be a lot of responsibility because this entire business now is on your shoulders. Thank you for listening.